if I am a degenerate retail trader and I'm like, cool, that's going to be really beneficial for Chevron or Conoco, I'm just going to YOLO my little bet in today.
Whether you like him or not, he's a consequential individual. Venezuela alone, in 2 weeks, it'll be on page 10.
On today's show, we're focusing on the fallout from Venezuela. We've got Frances Horodelski, who's been a financial journalist for over a decade, and before that, had a career in finance that spanned over 30 years. And then to talk about the investment implications, we've got Smead. He's a U.S. investor, but his biggest non-U.S. position happens to be a Canadian energy stock. Are we selling all our Canadian energy stocks? How much did the Venezuelan invasion screw Canada's bargaining power? The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Hey everyone, it is a brand new episode of In the Money with Amber Kanwar. A week earlier than anticipated, we thought we could just come back fresh and relaxed next week and deliver you fast-paced insights. But the news cycle had something different in mind. Of course, we all woke up over the weekend to a U.S. invasion of Venezuela, kidnapping of the president, Nicolas Maduro, and his wife, being brought and charged in the United States under the guise, I guess I would say, of narco-terrorism. But as the week has unfolded, it's also become very explicitly clear that it is about oil. And investors felt that way too. Investors are particularly concerned that this is negative for the Canadian oil sector. And the reason is because in terms of the kind of crude that Venezuela has, it's thought to be very similar to the kind of crude that Canada has. So now if all of a sudden the U.S. can get it from Venezuela, maybe they don't need it from Canada. There's all kinds of issues with that thinking. You know, this doesn't just turn on. It's not a light switch. Venezuela's energy sector has been neglected for years. It's going to take years and billions to get it up to anywhere to what Canada can produce. But still, it was a shock moment for investors. And so we want to know, what do you do with that shock moment? Do you lean in? Do you take pause? Do you take profits if you have them? To discuss that, we got to go to Frances Horodelski. She is my oracle on many things, but she's got this great way of kind of sober second thought. And then we're going to talk to somebody you should know by now, Smead. He's a U.S. investor, tends to buy a lot of Canadian energy stocks. So he's going to tell us whether he's leaning in or leaning out. As always, let's get into it. Frances, thank you so much for joining us on the show.
Happy New Year.
Happy New Year. Yeah, indeed. What a way to start. We're coming back early because this just felt like a topic we had to tackle. But you're my sounding board for a lot of things. And so this happened and we were texting each other. And, you know, I struggle with geopolitics because it seems like a really big deal. And then, you know, eventually the market just kind of gets over it. And so I think I asked you that. I'm like, is this a big deal or is this something we're just going to get over?
So I think that all of this stuff is a big deal. in some respects because it is a tower of big deals, I think, when it comes to the administration of the U.S. So, whether it's Venezuela or, heaven forbid, Canada invasion, these things are kind of being stacked up because it's part of policy. So everything political seems to be a big deal. But I wanted to step back a little bit, if I could, just about where we were coming in. And we'll start with the energy patch, because that's what, that's where all the drama occurred over the last few days. So I actually went back and looked at, and I was a bit surprised. I was surprised at the sell-off, because I thought it was silly in terms of how aggressive traders were in selling off Canada. But it's interesting that Canadian energy stocks have been pretty cheaply valued, let's call it cheaply valued, in the middle of last year. And in terms of performance, energy stocks in Canada doubled the performance of energy stocks in the US. And so the valuations as well has come right in. So where they were cheap relative to US and European energy stocks, they aren't anymore.
Yeah.
So, that was kind of the backdrop into which we arrived after this incident. Let's call it an incident in Venezuela.
Casual kidnapping of the president.
Yeah. So I think that's how we came in. And now we're kind of, moving back to slightly undervalued depending on a lot of things that happen. So that's the first thing I wanted to talk about. The second thing I wanted to talk about was everybody's all in a state of flux today because 30 to 50 million barrels of oil is making its way to the Gulf Coast, to U.S. refineries. Well, just by the way, that isn't a lot of oil. It sounds like a lot of oil. It's not a lot of oil. The calculation is 80 to 130,000 barrels of oil a day. America uses 20 million barrels of oil per day. So, that's the context. Canada ships 4 million barrels of oil a day to the United States. So, all those numbers you're hearing over the last few days sound like a lot. They aren't a lot. Certainly the refiners in the Gulf Coast are going to benefit, and you see Valero and some of these names bouncing a lot over the past couple of days. They're U.S. refiners. But, in the scheme of things so far, it's not a lot of oil. And the third thing, and everybody's talking about this, and it seems to be the consensus, is that the amount of oil that eventually comes out of Venezuela is going to take a long time to come out because of, from poorly maintained infrastructure right through corruption. So, going from 1 million barrels of oil a day in production to 3, all into the United States, going to take some time and at a price because, most of the big oil companies don't want to be producing oil if it's only going to be sold at $50 a barrel or $55 a barrel. They would, obviously like something higher. So there's going to be that battle between the cost and the price they receive. So Canada, somebody said, we're low cost and still low risk. And, it's not a monolithic group in Canada. You got to look at, the various players and where they sit in terms of heavy oil production, natural gas production. So, people aren't going to be able to just buy the ETF anymore. They're going to have to do their homework.
This is why I love you. This is why we love her, because you just distilled it so perfectly, explained why we had such a knee-jerk reaction. We had run up. Oil was down, and Canadian oil was such a strong performing sector. So it made it kind of an easy sell. The long-term analysis, the 5 days that we've had to sit with it is, this is probably maybe negative for supply, but it's a slow burn. I guess maybe, I love to get into the weeds with you, but at a 30,000 foot view, how much did the Venezuelan invasion screw Canada's bargaining power when it comes to dealing with the U.S., right? Outside of just those energy stocks, we're supposed to deal, we've got this renegotiation of NAFTA 2.0. And now all of a sudden we have all these barrels that we provide them. He can just turn around and say, I've found another supplier.
Yeah. So And that comes down to the politics of it. The rant, you may have heard the rant on CNN by Stephen Miller, I like to call him President Trump's Svengali. You look it up. It's not a nice person. His view is that anybody in the Western Hemisphere that does anything that is not in America's best interests, we have the right to do whatever we want. So that's where Greenland comes in. That's where Venezuela, Colombia, you name it. And that's probably where Canada comes in. And we certainly aren't going to be in the greatest bargaining position, but I don't think we're in a great bargaining position anyway going into the USMCA negotiations. Just by the way, PM Carney is going to China next week.
Yeah.
I think it's next week. All of it's very, very, very muddy. I'm surprised in all of that muddiness that the Canadian dollar really hasn't, fallen out of bed. It's not been great, but it hasn't collapsed. So that's something to keep in mind. I think the Bank of Canada has a lot of powder that they have dry to do something in the event that the wheels fall off the bus. But, I guess I just don't know when the administration in the U.S. then returns to its domestic focus. In fact, today they are. Mr. Trump's talking about housing. He's talking about defense companies and how he wants to cap CEO compensation. So it's pretty erratic, and that's why you have to.
Well, let me counter that. Like I think you can easily sell Venezuela as a domestic issue because it's for lower oil prices. Gone are the days where we used to pretend that these invasions were to liberate and spread democracy.
There's no pretense.
No, you just say, I want the oil. I like that oil. Yeah. There's also the narco-terrorism, which is, that's thin. And hardly a reason to go in and take a husband and wife, because there's a bunch of other countries that you could go and to deal with that. It's pretty overt. It's saying, yeah, we went there and hey, everybody, and we got you this oil. It's coming down a ship.
It's certainly a point, but it comes back to my other fundamental point is that if you're going to, quote unquote, I'm going to use the word steal, maybe that's not the right word, but a lot of this oil to dump into the U.S. to bring down prices, if you want companies to be aggressive in reestablishing Venezuela's production, you don't want $45 oil. You don't want $50 oil. You probably want $60, $65 oil. So is it a domestic and is it a short-term improvement in the price of gasoline? There's lots of things that go into that equation.
So there's a bunch of touch points. Like we've talked about energy. We've talked about trade with the renegotiation of NAFTA, the Bank of Canada maybe having some dry powder. What else besides, these things is on your mind? I know we got a lot of questions, and I've been thinking about, a bank like Scotia, for example, which isn't in Venezuela, but is in Colombia and does have exposure definitely to Latin America, which I don't know, what does that look like if it's, Trump's Latin America?
Yeah, I don't know. In fact, the Scott Thompson was talking about that at one of the bank conferences yesterday, I guess.
Definitely this weekend. I think he saw it as an opportunity.
Yeah. The problem is that for our banks, generally speaking, they aren't as cheap as they used to be. Again, and there's opportunity, but I tell you, if we go into some rip-roaring economic malaise here, and I like Scotia, just by the way. As Iona is finally breaking out after years of misery. And it seemed the other day that the Americans woke up to it because it was the best volume on the New York Exchange in like a year. And it's only been greater than what was traded on, I believe it was Monday in New York, only 3 other times. So they're rushing to Bank of Nova Scotia, maybe a gold play too, because they're getting back into the commodities business. Mm-hmm. But the bottom line is the banks aren't cheap right now. And if we go into some rip-roaring, no, it's not rip-roaring, falling out of bed recession, The banks shouldn't fare very well in terms of worries about loan losses and the like. So everything seems to, in Canada, actually, the things that we love to own in 2025 seem to be ahead of themselves. The banks, the golds, the coppers, and they all have strong fundamental stories, but they just feel, as I said, ahead of themselves.
Gold is interesting. Gold popped on Monday and Tuesday, gave back a little bit on Wednesday. And I just wonder, actually, let me just fact check that because I was looking at the miners.
That's true.
That is true, yeah. The miners definitely popped, yes, and bullion popped as well. We had this guest on from TD, Hussein Aladina, who's the head of commodities research. And he said, everybody has their own reasons for owning gold, but he says it's really been driven by these central bank purchases, emerging market purchases in particular. And he actually referenced when the U.S. left Afghanistan and how they took their reserves and how nobody really paid attention to that. But then when Russia, Ukraine, and they took reserves, then people paid attention to that, particularly these emerging markets and just the risk of holding paper. I mean, nobody talks about the fact that no matter how much gold you have, it's not going to cover, it's not going to pay the bills. But just as we get more of these events, that it's just this is another reason to buy gold.
And the quote unquote debasement of the US dollar, which had a horrible year last year. I'm not saying that I don't want to have my 3 to 5% of my portfolio in gold. I just think that, you look at the flows into gold ETFs, which are just soared and off the map. You look at the reserves around the world in terms of the emerging market, central bank buying of gold, China buying of gold. I mean, it all feels a little too much, too fast. I'm not an expert. I think people have 5,000 for bullion. They have 10,000 for bullion. I'd just be a little bit more circumspect over the short term in terms of what I do. And if you're really lucky last year, you might want to take your cost out if you own some of these miners. That's what I did.
I mean,
I think
think about that. Miners. Think about those miners, best year ever in terms of the gains. So yes, it was
huge. And if you take your cost out, at least you're running, with somebody else's money. So I think that's wise and you're seeing that a little bit in redeployment into some of the laggards. Mm-hmm. I think the utilities, which had to run and are kind of Canadian utilities, I'm going to talk about how to run and are kind of holding in. I think there's a place to maybe hide a little bit.
Healthcare, by the way, U.S. healthcare sector. It's only a couple of days, but a second best performing sector in the U.S.
Yeah, it's been doing so. You've got healthcare, you've got some of the defensives just to protect yourself. I'm a little bit more defensive. Could be all wrong. I can't get my head around software stocks, although they seem cheap, both in the United States and in Canada. There's been some reports that that's where some of this money might rotate to. So it's. Horrible phrase. It's a stock picker's market.
So, just to go back to Venezuela, are there other areas in commodities that you're focused on, like lesser focus but more punishing? Was natural gas was under pressure, and rare earths, concerns about rare earths.
Rare earths. I mean, I don't even know how you play it. I mean, there are a bunch of companies that. And you've seen them move. I just don't know how to play it. Maybe buy Ontario, because one day the
Ring of Fire
will be a thing. Palladium and platinum have been the big winners here recently. Again, they just look way stretched to me. Natural gas doesn't. There's a bunch of seasonality issues with the commodity. That, these aren't the best months for natural gas, but the companies themselves, you're going to be seeing reserve reports over the next couple of weeks, maybe into February, where they're in really good shape, Canadian natural gas companies. So that may be where the energy trade shifts, because if you're worried about, heavy oil, Athabasca, I don't know, to throw a name out, you may want to buy, a tourmaline, which I know you own.
Yeah.
I own it. I also own Birchcliff. So, maybe there's some opportunity. That's one place I would go. And what happens with the energy space is that, it's a dog and tail, or wagging the dog tail thing, is that when everybody runs out of the energy space, everything kind of gets thrown out. And then, even though not actually affected by what's going on. The only other thing I'll say is that, and this is the politics of everything, is I had no idea how all this unfolds with China, with, Russia. You've divided the world up into 3 autocracies. And what does that mean? I don't know. For my country, Ukraine.
I know Ukraine. Do eyes move to Iran? Just by the way,
of course, Iran's a situation that is, yeah.
Well, I was just going to say 2 weeks of, unrest there. Is that the next area of regime change?
But the Saudis and UAE aren't happy with one another either in Yemen. So, that area of the world is always an issue. So you could go through hotspots all day long. This is
why I originally texted you, because you've been in the markets for whatever, in some ways 30, 40 years. And so you've seen all these crises that people like me, we can run around like chickens with our head cut off and get worked up and excited and get in the weeds on all these little countries around the world. And ultimately, that's not always how you make money. I don't think geopolitics has been a successful strategy for making money. Where does this rank for you?
Well, I think I started by saying that because somebody keeps saying to me, the world changes when consequential people are in power. And whether you like him or not, he's a consequential individual. I'm talking about the president. So ordinarily, I used to always say elections and, government initiatives really in the end don't change the pattern of things, but he is consequential in the things that he's done and is doing. So it probably ranks up there pretty highly. Having said that, Venezuela alone, in 2 weeks, it'll be on page 10. And then, we'll be wringing our hands about something else.
All right. And maybe I'll bring you back on when we are. Frances, thank you so much. As always, I appreciate your sober analysis. That's Frances Horodelski joining me. We're going to talk about how to put this all into practice in the portfolio. Cole Smead of Smead Capital is joining us. Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Cole Smead, thank you so much for joining us on the podcast. As I said, you're in a really unique position because you're a U.S. investor. You could go anywhere in the world. You often look at Canadian energy producers. And I think post-Venezuela, the number one question has been, so are we selling all our Canadian energy stocks here?
Yeah, it's a great question. Thanks for having me, Amber. Let's go back to the last time we saw this oil price, broadly speaking, during the last 12 months. That was April. And there was this big headline, Amber, tariffs, super scary, super worrisome. And what it did is it drove investors to sell those stocks. The Canadian E&Ps were sold heavily, as also American E&Ps were sold as well. Now, fast forward to our conversation right now here at the beginning of 26. How good was that to follow those headlines and make any decisions off it? You lost a lot of money doing that, okay? And so I just say that because I contextually think of it like that. It's big and scary, kind of like tariffs were in April. Fade this. Fade these fears and worries because this too will pass. And it just, there's not much that can happen overnight. Something can happen over time on this, and I'm sure we'll talk more about that. But I think this is, there's nothing overnight to this.
Let's talk about that because tariffs, they were scary. The reason the market rallied is because they backed off on a lot of them, and a lot of them aren't implemented, and things got friendlier. So cut to 5 days ago, the U.S. goes into another country, removes its leader, arrests it, and says, we're going to restart oil production there. And we're taking barrels now, but 50 million barrels now. If you're to use the tariff analogy, doesn't some of that have to go away for this not to be a scary situation for the energy sector, for the Canadian energy sector? And we'll obviously talk about what this means for U.S., but
Sure.
That feels like comparing apples to oranges.
Well, so here's what I'd say first. Okay, so just use the tariff situation. How much of that is actually manifested? Well, to your point, not that much. Now, does it mean there's not pressure and pinch points? And, does the United States and Canada have different feelings and sentiments and relationships with each other? And, they have to, interact in different ways? That's all true. But it really hasn't changed very much. Now, I say that because there's a lot of economics that's kind of like physics. Newton's third law of physics is for every action, there's an equal and an opposite reaction. Okay, so this announcement comes out. So the natural positive reaction towards that is, when I say positive, is the reinforcing it to that is, oh, hey, heavy oil in Canada is going to be under pressure. Okay, that's the equal part of the reaction. The opposite reaction, though, is that ultimately, who that puts pressure on is the Carney government to deliver on what they've said. You were there, you were interviewing Carney at the Canadian Club in Toronto, and you said, what about pipelines? And he said, I don't want to talk about pipelines, we're going to get it done. Well, if I'm talking with Amber and we're going to get it done, the next time the president calls me and says, hey, you're a great ally to us, you're a strategic security partner, and by the way, I'm not just talking about pipelines, when can we get one ran across in the next 4 years? Because it puts pressure on them to say, we don't want to compete with Venezuela to get to the global oil markets. We want to provide more to the global oil markets to stifle investment there. Now, that's on the Canadian side. As I think about it from the U.S. perspective, to your point, 50 million barrels, 'tis merely a flesh wound. I mean, that is such a joke. That's a great headline. If I am someone who doesn't know this market at all, I think, wow, 50 million barrels, that's my president. That's so cool. Okay. The only problem is that doesn't do much on the blip of a day in the oil market. Okay. We're talking about $2.8 billion of oil. As they were announcing today, they said, hey, this is going to be marketed. And great. So it's being sold in the open market. Why can't it be sold necessarily in the United States? Well, most of the heavy oil refineries are sitting on the Canadian border or in the Midwest. Therefore, we have trouble processing heavy crude in the southern United States because we tend to process light sweet crude. Most of the heavy oil gets on a tanker and goes to other parts of the world. And so there's just real logical issues with this idea. Now, in the first couple days, as people are placing their bets, stock markets can unequivocally be popularity contests in the near term. But in the long term, they're never a voting contest like that. They're a weighing machine. You weigh two things ultimately, time and money. And that's the real conspicuous issue with a lot of this is that, let's say Venezuela has the reserves that they say they have, okay? Some would debate that, but let's just say it's big. One of the 3 largest reserves in the world. How do you get there? Well, Canada has one of the 3 largest reserves in the world as well. How did they get there? Time and money. And by the way, a lot of lost money, might I add, and a lot of wasted time, okay? And so when people add that up, let's say that Venezuela is going to go from doing over 1 million barrels a day today to 4 million barrels in 10 years, okay? And someone says, well, what's the rough math? About 2.5 million more barrels that go into the market every day from Venezuela, say 10 years out. Okay?
And just to be clear, this is a 100 million barrel per day environment plus that we currently
110. 110.
Yeah. Yes. Yeah. Don't forget those.
And let's add to that the year over year growth in the per day demand is running about 1.4 to 1.5 million barrels. That's estimated, but we'll probably find something along those lines. So as we move 10 years forward, let's just say on average, right? Because as economies grow and people get wealthier, which is the prosperity and progress of humanity in the long run, let's just say that's an average number, or we could even be a little more bearish and say, oh, it's going to be 12 million more barrels we're going to need in 10 years per day, okay? Well, that great 2.5 million, that does about 20% of that based on my rough math. And so where are we going to get the other 10-ish or just shy of 10 million barrels? So, and given, like physics, so Venezuela is, and somehow having less dictatorship control, we could debate that, but let's just say it is. And let's say the economy is going to grow and flourish. I talked to my cousin who lives in South Florida. His wife is Venezuelan. I said, how does she feel about this? She said, tears of joy. So it's like, wonderful. This is awesome. Do I think the Venezuelan economy will pick up? Yes. So what has no one said? What will be the natural growth in demand just in Venezuela from the economy picking up because it has more freedoms? That is a very natural thing that comes with freedom and wealth. You always cause higher demand for energy. And so it's really bizarre to hear these arguments where it's like, oh man, the supply issue is going to be this massive overhang. And it's like, but the future's always bright. The demand is going to grow not only in Venezuela at probably a higher rate, but it's going to grow in the world. And so time and money is how those things are abridged.
So you're not being scared off of Canadian energy. How does this apply to the US? Because there was that pop in US producers, and, love him or hate him, but when US President Donald Trump wants to do something, he wants to do something, and he's going to find a way to do it. And he's bringing these executives in the US along with him to figure out, how do we get this heavy, difficult crude into something that is usable? He explicitly said, so that we can keep oil prices down for Americans. I mean, that, you can be dismissive of how bearish it is for Canadians, but can you then be optimistic about what this means as a growth opportunity for U.S. producers?
Sure. So so obviously Chevron already produces in Venezuela. Conoco used to produce there up until they had their operations taken away from them. Okay. And so if I am a degenerate retail trader out on Reddit or X, and I'm like, cool, that's going to be really beneficial for Chevron or Conoco, I'm just going to YOLO my little bet in today because you know what? I got bored with Bitcoin overnight. Okay. And I'm going to go make that bet. Well, what is not being said in a lot of this is because investment hasn't been there, because the risks have been so high in Venezuela. If Conoco came back into the country today and said, hey, we're going to come back to our old investments and just start doing what we're doing overnight. That's not how it works. If you talk to businesses where the government, typically the military, took over the business, you'll find that the capital assets either got ruined or they're not even there because they've been sold off to other people. Okay. And so just the practical implications of this are different. Now, to your point on the current administration, here's what's likely to happen. They will have to backstop losses through subsidy. Okay. Now, why do I say that? What do we know of commodity markets? Commodity markets at low prices, people don't want to supply the market. At high prices, they want to supply the market. So it's like, if you go ask a gold or silver miner, hey, are you ready to pull gold or silver out of your mines? They're like, yeah, there's never been a better time to do it. Okay. If you ask an oil business, not necessarily. They're not very excited about pulling the commodity out at these prices. And so if I have to go to a higher risk place like a Venezuela, where I historically have to pay bribes and do corruption and do stuff like that, we'll call it, what some would call, in some cases, depending on parts of the world you're in, there's others like Glencore that have had to deal in high risk markets like this, historically speaking. If you take more risk, you have to be compensated more. So they're not going to go out and be like, what's it like to invest in Canada or the United States? They're going to take a margin above and beyond that to get the internal rate of return that they expect. And when you do that, and the government wants you to do that, that's called subsidy. They will pay you or reduce your losses to be in that market because technically there's been a market failure in the government's mind. So this is all great because, again, our biggest problem, this is not a negative, is what I'm trying to get at. If the U.S. government wants to backstop losses or provide subsidy to U.S. producers to go in those markets, In the long run, that's not a problem because ultimately one of the biggest things that can be seen is we are going to have more than 10 million barrels needed in 10 years. And it is very hard at $55 to $60 WTI to see where those barrels are going to come from. I mean, OPEC's brought back a lot of their excess capacity, with Saudi Arabia being the only one really left with any excess capacity. If they brought their excess capacity, who else is going to bring it back?
So what does that mean for what it looks like in your portfolio right now? Because you're an everything investor, but I want to stay focused on energy. You do invest in Canada. You do invest in US. Mm-hmm. Like what looks like the ideal kind of tilt right now?
Yeah, if you don't have to dream at all, you're not finding a good enough investment. Okay, and here's why I say that. Okay, use the reaction from this. Okay, people that went out and bought Chevron on Monday, or bought Conoco on Monday, which we own Conoco. There was a big pop in those stocks on Monday, and then what happened Tuesday? Pretty much whatever they gained on Tuesday, or gained on Monday, they lost Tuesday. And look at today, it's all gone. Okay, and so I say that because did you have to dream at all to think that Chevron was going to produce maybe some more oil in Venezuela? No, no. Everybody with a cell phone could have told you that. Okay, but 2 days later, it didn't matter. Okay. Versus saying, okay, let's dream for a second. Let me give you my dream scenario. And we just started buying a newer heavy oil business in our portfolios, and I'll kind of give you the context to dreaming. Okay, I turned to our team, we got great people here. So I turned to our team. I said, these are the times that you want to go out and dream because no one else can. In other words, they don't have the ability or they don't have the mental freedom to, for one reason or another. Okay, and so I said, why do I want to dream? Because at $55 to $60 WTI, no one's dreaming. They're not thinking about how good could this business be if the right circumstances play out, because everyone's looking and saying, oh, look at the bad circumstances that have played out, which, by the way, aren't that bad. But it just shows you the human psychology, and as Munger once said, the psychology of human mismanagement, okay? And that's going on right now. So I want to sit down and say, okay, I know the economics of this business have never been better on a capital structure. I know these businesses have never been more efficient. I know that they're going to continue to consolidate, and that's something we could talk about too, as we've seen here more recently, and they'll continue to do that. And what that's driving, it's producing operational efficiencies, return on capital increases, and ultimately higher valuations because liquidity adds value. And I want to dream about what's going to go on in the industry off of all those good things going on when, to your point, the world doesn't have enough oil. Now, Venezuela can help the world with its oil problem. But again, like I said earlier, it's going to require a lot of capital and time, which has really been a tough thing over the years in this industry. And it's interesting to think about the capital. I mean, look how scarce this is in markets. I mean, the S&P 500 is less than 3% in the energy industry or energy sector right now. That's both servicers and producers. So think of how crazy it is to think, oh, there's just going to be $100 billion of institutional capital that's going to wake up tomorrow and want to capitalize Venezuela. I mean, that is fantastical. I'd rather bet that fairies are real.
Dream. So that's what I'm trying to understand, use the word dream. Like, that seems like we need something more concrete than that. And I assume it's more than a dream. You're telling us, I think for regulatory reasons, you can't name the company.
But I'll give you a tangible example if you want.
But just to be clear, you are running toward a Canadian heavy oil producer right now.
Yeah, someone who's got a greenfield project. Okay, like literally creating an asset today. Okay, so track with me here. We were talking to the folks at Strathcona. Okay, and we were obviously the Meg thing went down. They got the Saskatchewan asset. That whole saga's over. And so we were talking about the kinds of assets that they might be interested going forward, et cetera. And as they're talking about, we can go out and build, new barrels, new flowing barrels at $30,000 per barrel. It's like if you go out and look at the open market, you can't do that. You cannot go out and buy barrels, flowing barrels, that cheaply today. So why do I say that? They're looking and saying, can I buy the barrel cheaper than I can build it myself? And that's marginal growth that they're adding to their production. But I just pointed out because a greenfield project is just truly creating production out of thin air in a new asset versus adding barrels to existing production. If you can go out and add barrels at $30,000, I'd add barrels. Why? Because I want to be at the capacity that in 5 years or 2 years or 7 years or whatever that number is, when this near-term tumult passes in the commodity, where I am meeting the needs of the world at the demand level it's going to be at and at the production level where I get incredible prices. One of the tough things for some companies will be when the prices get better, especially in long-tailed assets like the heavy oil businesses are, where there's low declines, but it takes you time to get to those structures. Who will be ready to meet the demand at higher prices? And you have to actually start that today. Otherwise, by the time those prices are there, everyone's going to want to add barrels then and try to figure out how to do that. You have to actually plan for that now.
So the homework you're doing, you use Strathcona as an example. That's been a punching bag. CNQ, Canadian Natural Resources, has been a punching bag for some time, but this is yet another excuse. Cenovus, which I think you own as well, has been a punching bag. Anybody who's a shareholder in those stocks wondering, do I sell because of this Venezuela risk? What's your message?
I mean, the Monday move in Cenovus was obscene. I mean, it was just like you're sitting there, it's like, this makes absolutely no sense. If let's assume for 2 seconds that Monday was rational or the last few days are rational. Let's just assume that. So as I remember looking at my Bloomberg terminal at that time and looking at the stock prices, and it's like, okay, wait, Strathcona, who has no refinery assets whatsoever and is long heavy oil and bullish on heavy oil, I might add, to their credit, is down less than Cenovus, who is refining parts of their asset base in, and thus has a hedge on the price because if differentials open up, they make more money. I mean, that made absolutely no sense. So here's why I say that. Really important. And I know this sounds simple and it sounds cliche. It's just matter of fact and it's true, is markets are not there to instruct you, right? Some people went to the market on Monday and said, here's what the market's telling me about the future. Okay, now, if that's how you make your money, God bless you. I pray the best for you. Good luck, okay? But I'll use our investors. That's not how they make their money. They let markets serve them. How do they let them serve them? Hey, the market's doing something really perversely bizarre that doesn't actually make economic sense or logical sense in some cases. How do I seek to profit from that? That's the only way to deal with markets. And I think that's what's really missed. Buffett's talked a lot about this over the years. He talked about Mr. Market. So you come in on Monday and Mr. Market's really worried about the business you own together. And it's like, well, if he's worried, I'm a buyer. Okay. There's other times where he walks in, he's like really excited and euphoric. Think of like American tech these days. And it's like, oh, that guy's a buyer, I'm a seller. Okay. And that's how we interact in markets. You want to take advantage of this. Now, when we talked this last April or early in the year 25, I should say, I told you that I think it was maybe February or March. I said this was the second best buying opportunity the last 25 years in the energy business. Okay. Test that theory. Was it right? It was right. It just was right. Okay. Now I point that out because look at the stock prices. Look at this near-term tumult. Is it anywhere near what we saw last spring or early in the year in 25? No. And that was not that big of a deal. And so I look at this as it's headline risk. It's the president saber rattling. It's questions and, what is the construct of the global world order in 2026 and the corollary to the Monroe Doctrine and all this, really fun stuff to talk about. Don't get me wrong. I just don't see much changing in the global energy game because capital and time are needed. You can't just write code to do this, and you can't do it overnight. And why I love that idea, plus one other really important thing, is this is an industry and a part of the market that most people have lost a lot of money. The secret to life is weak competition. And just think, I get to compete, or our investors get to compete with people who are historically not very good at owning this sector. And why I love that is because I'm going to beat people who are shorter, slower, worse looking than me. You got to be pretty bad at that, by the way. And that's my opportunity in life. I can't. The old saying is, if you want to beat Bobby Fischer in chess, you got to play him in anything but chess. To be a good, successful investor, I can't play chess against Bobby Fischer, but I can go play him in the energy business. You know why? Because even Bobby Fischer probably lost money in the energy business.
Well, I wonder if somebody's going to take that ethos and apply it to M&A. Obviously we saw that, chaos with Strathcona, Meg Synovus, and it all played out the way it played out. Now that these prices are under pressure again, you think we're going to see a resurgence of M&A?
I mean, we should. There's no question about that. And I say we should because, as an example, Tamarack and Headwater should be dancing and mating and doing all the fun stuff that you come together on a great marriage. Okay, that should be going on. There should be others like that. We don't own them, but I don't think there's a good reason that Athabasca is developing a Duvernay asset that should be sitting in Spartan Delta, for example, which we don't own either. But again, there's a lot of this that's cool. Really quick, the energy industry has been ran by engineers historically. Okay, you go to the executives, a lot of these businesses, they're all engineers. Okay, go look at the boards. Okay, if they don't have a lot of the jokers on the boards that this industry has, and there's a lot of jokers and professional boards in the energy business, you're welcome for me telling all you that are on those boards. The engineers dominate those boards too. Okay, now why do I kind of mock and ridicule them? Congratulations, we're exposing people who have been 20-year terrible investors. 20-year terrible investors. So I point that out because ultimately what this industry is going to morph into, and if you disagree with this, I'm sorry, but you're wrong. You can send either Amber or myself some hate mail later, and we will delete it, okay? But I say this because where this industry is going is it has to treat investors incredibly well. It's going to be dominated by people that think about it from a financial investment perspective. So you're going to see the Adam Wattresses of the world dominate the industry. You're going to see people that have financial backgrounds, that could be sell side, that could be accounting, etc. They're going to become more the people that lead these businesses longer term. That doesn't mean the people in the field aren't terribly valuable. They are. It doesn't mean the engineers aren't terribly valuable. They are. But if you cannot successfully invest in this arena, you will not have a company. And to your point, we're going to get rid of a lot of the bad investors of the past. Let me add one more thing to that, if you don't mind. The other thing that I would add that we should really be seeing, that I think we learned from that saga of merging, is shareholders should be in control of these businesses. Why did Meg not close so quickly for Synovus? Because the shareholders were in control, not the board of Meg, the shareholders. So if you happen to own a company and they send you a shareholder vote coming up this spring that says you should give up certain voting powers to the board in a poison pill format, and the ticker of that stock happens to be TVE, which, if you don't know this, it's called Tamarack Valley Energy, you should vote no, because that's stupid. You should not give up your right as shareholders. And I don't care whether you have 100 shares or you have millions of shares and you're high up on the Bloomberg for the holders of the stock. You shouldn't vote for that, because ultimately the shareholders are the powerful creatures in this game. They are the ones that have the rights. They're the ones that take the economic risk, and they don't get paid to do anything other than just be owners. That's different than a board, and we should not give up our rights. Why else would I add to that? Because as we learn from the Meg saga, under Canadian securities law, for better or for worse, these companies can do whatever the hell they want. One other thing, I'll quote your conversation with Mark Carney. You asked him, why would foreign investors come to Canada? And his answer, Amber, was rule of law. Well, what I found out as a foreign investor coming to Canada is those are not rules. Those are merely guidelines that you can choose to accept or not. Okay. And so I point all that out because we already give up a lot just by being minority investors in Canadian securities that are under Canadian securities law. Why would we give the board more power? Because ultimately, if you're in this space and you're taking these risks, you are the powerful person alongside of your other partners in these companies. And I think you are a better judgment of what the company should do than the boards are in most cases.
Listen, I'm not gonna fight you on most of that, except I don't delete hate mail. I'm okay with it. You want to send it to me? You go ahead.
No, I'll read it. I'll laugh at it and then I'll delete it. I agree. I'll see it all.
Okay, but I do want to pick up on your point about politics.
Yeah.
Because, as much as you want to say that maybe this is a nothing burger for now for the stocks, you still like those Canadian stocks, you're not running as much towards the US energy producers. It does seem like it could catalyze some action, at least that's what everybody thinks, around a pipeline. Do you feel that way? Are you investing like that is a potential? And what happens if it still doesn't catalyze a pipeline?
It's a good question. Go look at the WTI WCS spreads. Okay.
This is the difference between the U.S. Oil price and Canadian oil price.
Correct. Yeah. So the difference between West Texas Intermediate, which would be a U.S. oil price, versus Western Canada Select, Hardisty as they call it also. So if you look at that, the history of that is that under duress, extreme duress, that could open up more than $25 of spread, but as high as $40 in just rare circumstances. So if you look over the last year, a little over a year, you'll see that that's been running anywhere from a low of, say, $9 to the more recent picture of, say, $13 and change. I think it was closed yesterday. Okay. So why is the spread so much tighter than the past? Well, first off, you have things like TMX have come online. So there's just more pipeline capacity. But ultimately, I think what the market's doing is it's sniffing around and saying, you know what? If Carney says that pipelines are going to get done, why would you say that unless you actually meant it or you thought it was plausible? Now, if I go back and look at the history of the spread business, what does it teach me? Well, if I invert the thinking of the spread business, it meant that pipelines have over-earned in the past. Because if you give me $40 spreads or $25 spreads, that's a lot of money to compensate me to get it down to the United States. Okay? And also, I would say refineries over-earned because that spread is something I could collect and make money on too. So I think pipelines and refineries have over-earned on that in the past from a Western Canada Select perspective. But what it means is that with pipeline access going more ways, they will under-earn compared to the past. Pipelines particularly, because ultimately your spread is your margin or your profitability. And if Carney goes out and says, great, we're going to subsidize this, we'll get another one done because we want to be a great strategic ally of the United States for whatever reason. And oh, by the way, we don't have to compete with Venezuelan oil and we think that's good for Canada. That means a pipeline is going to earn far less than it did in the past to push the oil. And so, as will the refiners. And so I say that because what do I think is the most pragmatic? And if I'm going to try to make a lot of money in the energy space at large, unhedged, I want to be long oil and I want to be as bullish as all get out. I think that's the best way to make money versus if I'm in the business of owning refineries, I'm more hedged. I want more spread, things of that nature. And I don't think that's the right view. So the people I admire and respect the most, why am I buying a greenfield company right now? Someone that's building an asset. Well, because ultimately they're going to be producing a lot more in 3 years. That sounds terribly bullish on the 3-year price out. And if they're going to be producing a lot more in 3 years, that's a bullish view. If someone's like, I like my refineries, I would be selling refineries. To your point on U.S., we just got to see Oxy sell their chemical business. Great sale. It's kind of like the refinery business. You can take the byproducts in, you can make your money off that. But it is not, you're not as bullish on the energy price, things of that nature.
You're selling even U.S. refineries, like a Valero, which has run nicely.
It's popped beautifully. I don't understand what that changes overnight. How many refineries on the U.S. South are doing heavy oil? That's a good question for everyone to follow up on. How many pipelines could run that heavy oil in from Venezuela into the Midwest market, let's just say, and what would that pipeline cost? I mean, those are all real questions.
And it's small.
And again, everyone can figure that out. But I'm just saying those are questions you should be asking.
But before our time runs out, I want to ask just about different ways, different tentacles. Kind of, people look at the events of Venezuela and they think, okay, what's next? Colombia. Then they look at a company like Parex Resources, which does have operations there. Even Iran. Look at unrest in Iran and the potential for regime change there and what that does. It does to a lot of things, but for this context, what it does for the energy markets. How do you think about the tentacles of this Venezuela action?
Sure. So in the long run, the major U.S. oil producers always had to go offshore. And here's why I say that, because that's where long-term projects are. If you're not going to go build long-life assets in Canada, offshore is a very natural extension. And so as I think about places like Guyana, we just watched Chevron and Hess fight over Guyana.
Mm-hmm.
We own APA, who has a nice offshore asset coming online over the next few years there, which is a U.S. producer, Permian and offshore.
Apache, right?
Yeah, Apache. Yeah. Well, they just go by APA Core now, just to be technical. But so I think about it like this. Permian assets are short twitch muscles like your body has, and Canadian, SAGD assets, oil sands, and offshore projects in Latin America are what I'll call slow twitch muscles like your body has as well, or long life assets. And sometimes the fast twitch work, because if oil prices rip and you want to get a lot more production on market, it's easier to do that through fast twitch muscles. And if long-term the price of oil is going to be better, it's easier to do that in some other cases in long life assets where you don't have to reinvest all the time. Okay. And so I think of them differently for different reasons. But I say that because ultimately I want to be bringing oil to market in the next 10 years. I didn't want to bring oil to market in the last 10 years. And so that's how I think about the construct. When did most investors get excited about this space and want to dream about new projects and build those projects and do all that stuff? Was in 2014 at its height, but really the 2010s. In the next era, this will be the most attractive. And we're really just finishing the last era in some respects. Someone says, what are we paying attention to? Rig counts, frac crews, the production in the US markets. Those are the things we're looking at, because the question is, certain things have already turned south, but when does the actual production number fully go negative, okay, in terms of growth? One thing to add, if I can find an energy company like an Oxy today, where they just sold their chemicals business to Berkshire, and by the way, Oxy owns another business called Western Midstream, WES is the ticker in the US. They own 40% of that business. Well, if you go look at the midstream business right now, their stock prices haven't moved at all. They're doing just fine at multi-year highs, I think, on Western Midstream stock case. But if I have $6.4 billion in a midstream business that is doing fine right now, wouldn't I want to sell that midstream business and go out and reinvest that either in my own stock, in a buyback, or by just reducing my capital structure and returning that to shareholders in some way? I would. And so, as I'm looking this, it's like on a day like today where those stocks are getting battered, I want to take advantage of Mr. Market. I have to use capital allocation to do that if I'm an issuer like Oxy. We don't get to decide that, they do. But that's how we'd be thinking about capital allocation for companies. And back to your point of consolidation, this is a great time for those marriages and those matrimonies on an all-share basis. That way they all benefit from the upside. But that's it. I don't really look at the border as that big of a deal. Because, Chevron might benefit because they get some of their losses backstopped, and maybe Conoco can get their assets back. But where we're going is not, it's going to be so bright and rosy, we're going to get back to $60 someday. That's not the way this game's played. The only way people are going to grow production in the long run is high prices. Because during the 2010s, that's what caused them to, grow production.
Well, and I wonder if you've thought about whether, like, so much of what has happened recently has been like, yes, to your point, producers selling assets, getting laser focused, getting better at capital allocation, taking money, returning to shareholders, which I know you don't love as a US investor, but Canadian investors love that. And getting rid, punting sort of extraneous assets that aren't necessarily in Canada. But, let's bring up our friends, the engineers, which I think you did them a little bit of a disservice, but they know something about heavy, complex crude, right? And maybe there's an opportunity for Canadian producers to go to Venezuela because there's expertise, similar kind of crude. Like, we look at it as a negative, maybe it's a positive. Do you see a world where Canadian producers, and I don't think this is consensus, I think most people dismiss the idea, but if you're trying to get that stuff out of the ground in an efficient way, why not look to Canadians who know how to do that?
Sure, and I think they will. I mean, for example, Conoco produces in Canada.
Yeah.
So is it a stretch for them to want to produce heavy oil in Venezuela? No, not at all.
No, but I mean, like, could a Canadian producer, do you think Canadian producers will start expanding again if Latin America becomes an opportunity?
Yeah, no, to your point, Amber, if the government provides you subsidy, people will do anything. Okay? And I just, that holds true. So there's no question about that. That if there's subsidy programs, they're very bright, intelligent people in Canada. They might not always be in the C-suite, and they might not always be in the boardroom, but there are intelligent people out there. And they will always run towards opportunity, and that won't change. And so I agree with you. If someone says, on the margin, who are the best heavy oil people in the world? Canada. It's my big idea. So I agree with your view on the engineers. By the way, real quick, for all you engineers out there, I freaking love you. If you're in the C-suite, I love you a little less because there's been a lot of stupid things to go on. But everyone else outside that, God bless you. I hope you live to 100 and get hellaciously rich in this business because you should.
Okay, before I let you go, just top conviction right now in the energy sector. You and I are going to be, I think you might be our most frequent guest now because I'm coming to Phoenix in about a month to MC your investor day. And I think you're going to reveal some new Canadian names, but you're going to have to wait for that. Do you have anything for us today on the energy sector? Any high conviction ideas?
Yeah, I mean, we took our MEG shares in shares. We did not, sell any shares off of that deal. And what was really disappointing, Amber, is if you look at how MEG wrote their tax laws or their tax, indication for the U.S. holders, we got full capital gains on that transaction. We didn't get to roll our gains forward. Really disappointing. Again, I really didn't like how the board treated us as shareholders in the end with that. If you're Canadian, you didn't have to deal with that. God bless you. You're more special in this life. So I say that because we've sat on our entire Cenovus position. It sits on our non-US portfolio. It sits, over 12% of our fund today. So that's a big position. It's our by far biggest position. So, again, with the Monday's reaction, I don't think anybody understands what's going on at Cenovus. But here's the one thing I will say. As I watch refineries rally, the refiners are rallying. What would I do? If I'm John McKenzie, I'm Cam, I go to my board and say, guys, Monday's reaction was utterly ridiculous. Let's sell our refineries and let's take that capital and let's go buy back our stock because they think we're a dead duck. That's what I would do. Now, that's what our investors would do because they want to get rich. That's their point. If you're going to take all these risks and deal with this volatility, you got to get compensated for that. And the way to get compensated is to build a lot of wealth. And so that's what I would be doing. That's what our investors would be doing in that case. Now, do I expect them to do that? No, I don't expect them to do that. But I think that would be the best capital allocation right now. As I step down from that, Strathcona just did their $10 special, which had always been talked about. Take Adam Watrous at his word. He's an honest guy. You just don't like him because he says what he thinks. That's so unlike a lot of people in this industry where they'd rather be dishonest and say good things and tell you other things when the door's closed, okay? And so I would just say, take him at his word, $10 special. In our case, and in Canadian investors' case, it was return on capital. For us, we got treated as a partial capital gain, but not a dividend. So, we got to pay our capital gains on that part of our stock, treated us very well. They're going to go grow production. They said 200,000 barrels. It's not a greenfield, but they're going to grow production. And I very much our investors want to grow production into this environment. So those are our two biggest. The stock we got involved in the last season of Tumult was Tamarack Valley. Something that we've done a lot of work on, and I would throw out to you, again, from a finance perspective, go look at DD&A, depreciation, depletion, and amortization. It's a line item in the income statement. And this is kind of like a masterclass that I think I give a lot of credit to Connor Watrous, particularly that he reminded me of this. But and I would also throw out, there's another founder out there that created a company. It starts with an M, it had an E in the middle, and had a G at the end. Who told me he said that the original production facility at Christina Lake was only going to process 60,000 barrels a day. And that same processing facility ended up processing 108,000 barrels a day. So when I think about the accounting of a business, all those great engineers, back to our great engineers, who were able to pull that off, what it means is that when they originally built that asset, the depreciation of it is much lower than it should have been in the end, because ultimately they didn't need as much capital to process more crude. And why that's valuable is that if you look at DD&A as a percentage, as a portion of a barrel, and you put it in dollar terms, you want to find companies that have low DD&A per barrel. That's a metric we want to look at a lot, and we're really laser focused on. Depreciation.
And Tamarack Valley screens well.
Well, here's why. So every time they're water flooding right now, by the way, just so you know, water flooding is not a new technology. Saudi Arabia has been water flooding for decades. If you look at their oil fields, this is 100-year-old technology. Okay. And so when you water flood, you're putting pressure in the well, not a lot, but you're putting pressure in the well to get more oil out of it. But what you're also finding is that every time they report, they're announcing new or higher reserves. Now, I point that out because when you look at the DD&A, the first part is depreciation. The second part is depletion and amortization. Amortization is, okay, I bought, if I buy a company with 1 million barrels of reserve and I wake up later finding out that I didn't have 1 million barrel reserve, I had 2 million, it means that every barrel I pulled out, for the first 1 million barrels, I showed my amortization at, whatever that was relative to the cost I paid. But the second million that I put into my number when I bought, I show a 0 for that. And so what does that mean? It shows you that the economic earnings were higher because I didn't pay for those barrels. And so DD&A gets you to two things. It gets you, one, to the assets you built to process crude. But the amortization tells you how good is the company at buying reserves that end up being way greater. Okay. And every time they water flood at Tamarack, they announce, oh, by the way, here's how well we're doing on our water flooding. And oh, by the way, our reserves are going up. They never paid for those when they bought those assets. So I use that as an example of looking at what we think is going to matter in these businesses. You get those reserves for free.
Great chat. Great perspective on a week where investors have a lot of questions about their holdings. And I look forward to seeing you at your Investor Day in Phoenix, February 2nd. And there's going to be an opportunity, if you're not there, for people to ask questions, right, Cole, over social media?
Yeah, I think we're going to go out on X and put it up on Spaces. To Amber's point, smeadcap.com/oasis. And so if you want to start firing in the questions, it'd be really fun to have those live at the event, and it'd be a lot of fun. Your first time coming, Amber. I can't wait to host you and have a good time, and I know your team will probably have a good time while we're in town there.
Just if there's sun, that's all you need to say, because we're in a dark cloud over here. Thanks so much. That's Cole Smead of Smead Capital joining us. Don't miss our next episode. We've got David Burrows of Barometer Capital. You can get your questions in now. Email questions@inthemoneypod.com, and we'll see you on the next episode.